The silver market is starting to feel tight, not loud yet, but noticeable if you're paying attention. Prices still look calm on the surface. Underneath, stress is building. Look at how quickly physical supply is moving. Bars aren't sitting around very long anymore. Dealers are restocking more often than before. That alone tells you something has changed. You don't see panic buying, but you see steady pressure. And steady pressure is usually more important. Premiums are staying elevated in quiet ways, not spiking, just refusing to fall. Why does that matter? Because premiums usually drop when supply is comfortable. Right now, they're not. Inventory data is sending mixed signals. On paper, there's silver available. In reality, delivery timing is stretching. Some buyers are being told to wait. Others are paying more to avoid waiting. That gap is where stress lives. Look at how futures and physical prices behave. They're not always moving together. That disconnect isn't normal for a relaxed market. It suggests something behind the scenes. You don't hear officials talk about it much. They rarely do when pressure starts quietly. Silver tends to whisper before it speaks. Industrial demand hasn't slowed the way many expected. Manufacturers still need consistent supply. They don't care about price headlines. They care about getting metal on time. That keeps a floor under demand. Meanwhile, investment demand hasn't disappeared. It's just less emotional right now. Calm buying can be more dangerous than hype, because it doesn't turn off easily. Have you noticed how quickly dips get bought? They don't last long anymore. That's another sign. Refiners are also facing tighter margins. Input costs aren't falling fast enough. That pressure moves downstream. It always does. Transport and insurance costs add friction too. Nothing dramatic, just constant drag. And drag adds up, so the market keeps absorbing stress. The question is how long it can do that quietly. Silver stress doesn't announce itself with headlines. It shows up in small delays and quiet adjustments. Watch how contracts are structured lately. Flexibility is becoming more valuable than price. That tells you participants are hedging uncertainty. Not fear, just caution. Caution spreads fast in commodity markets, especially when supply chains are tight. Some traders are rolling positions more frequently. They don't want to be locked in too long. That's not confidence behavior. It's risk management. Open interest numbers look stable at first glance, but dig a little deeper. The composition is shifting. Short-term positions are rising. Long-term commitments are thinning out. Why would that happen now? Because nobody wants surprises. Silver has a habit of creating them. Physical settlement remains a sensitive point. Most contracts don't go that far. But when more people consider it, stress builds. Even if settlement never happens, just the possibility changes behavior. Vault movements are worth watching closely. Small outflows matter more than big inflows because they're harder to replace. Some locations are seeing steady drawdowns. Not dramatic, but persistent. Persistence is key here. 1 week means nothing. Several months mean something else entirely. You also see tighter specifications creeping in. Quality requirements are being enforced more strictly. That limits usable supply, again quietly. The market absorbs it without noise, for now. Price volatility remains contained, but compression often comes before release. Have you seen this pattern before? Silver traders usually have. It never moves when people expect it. It moves when positioning is wrong. Right now, positioning looks cautious. Cautious markets don't stay quiet forever. They're just deciding which direction matters most. There's also a psychological layer to this market. Many participants are watching, not acting. That creates tension without volume. Volume usually comes later. Right now, it's all about positioning. No one wants to be early, but no one wants to be last either. That balance doesn't hold forever. Look at how spreads behave during quiet sessions. They don't narrow the way they used to. Liquidity is there, but it's selective. Some bids disappear quickly. Offers hesitate to step down. That hesitation is meaningful. It shows uncertainty about replacement cost. When sellers hesitate, supply isn't comfortable. Producers feel it too. Forward sales aren't as aggressive. They're leaving more exposure open. That's a subtle shift. Producers usually love certainty. When they pull back, it's worth noting. Financing conditions play a role here. Credit isn't getting easier. That affects inventory decisions. Holding metal costs more now, so inventories get leaner. Lean inventories increase sensitivity. A small shock can travel far. We haven't seen the shock yet. But the setup matters more than the trigger. Refined silver output isn't accelerating. Capacity exists, but expansion takes time. Time is the one thing markets never have. Industrial buyers know this. They plan months ahead. That planning locks in demand. It removes flexibility from the system. Flexibility is what prevents stress. When it fades, pressure builds. Are people underestimating this phase? Many do, because it's boring. Markets lull participants to sleep first. Silver is especially good at that. Silence feels safe until it isn't. The data doesn't scream, but it doesn't relax either. That's the warning. Another thing to notice is how commentary has changed. There's less confidence in long-term forecasts. More people are sticking to short windows. That's rarely a sign of comfort. When outlooks shrink, uncertainty grows. Silver traders feel that instinctively. They've been burned by sudden moves before, so they stay light. But staying light has consequences. It reduces buffer capacity. Buffers are what absorb stress. Without them, pressure moves straight to price. We're not there yet, but the path is visible. Look at how quickly sentiment flips on small news. Even minor reports move the market now. That sensitivity wasn't there before. It's a sign of tight balance. Too much demand doesn't exist. Too little supply doesn't exist either, but the margin between them is thin. Thin margins don't forgive mistakes. They amplify them. Logistics remain an overlooked factor. Delays aren't headline news, but they compound quietly. Missed deliveries create scheduling problems. Scheduling problems create buying urgency. Urgency changes behavior fast. Some buyers are locking contracts earlier. They're paying slightly more to do it. That's not speculation, that's risk avoidance. And risk avoidance often comes before stress events. Meanwhile, scrap supply hasn't surged. Higher prices usually bring it out. So far, it hasn't responded much. That limits secondary supply. Primary supply carries more weight then, and primary supply is slower to adjust. This is where patience gets tested. Markets hate waiting. Participants start making assumptions. Assumptions turn into positioning. Positioning creates vulnerability. Do you see how quiet markets can be dangerous? Silver doesn't need excitement to build pressure. It just needs time. Time is doing most of the work right now. Every week of balance tightens the system. Nothing breaks, but nothing loosens either. That's an uncomfortable place for a market, especially one as small as silver. Size matters when flows change. A modest shift can move everything. That's why attention is increasing quietly. Not from the crowd, but from professionals. They don't chase headlines, they watch flows. And flows are telling a careful story. Import patterns are becoming less predictable. Some regions are pulling forward demand, others are delaying shipments. That unevenness creates friction. Friction increases stress. You can see it in contract negotiations. Terms are being revisited more often. Flex clauses are more common. Nobody wants rigid exposure. That reluctance signals uncertainty. Storage behavior is also shifting. Holders aren't rushing to release metal. They're waiting for clarity. Waiting tightens availability, even if total supply hasn't changed. Availability matters more than totals. It always does. Short-term leasing rates hint at tension. They're not extreme, just elevated. Elevated rates discourage lending. Less lending means less circulation. Less circulation increases pressure. The market still functions smoothly, but smoothly doesn't mean safely. Smooth markets can hide imbalance. That's what makes them risky. Retail demand stays steady in the background. Not explosive, just consistent. Consistency is harder to manage. It doesn't fade with sentiment swings, it just keeps pulling metal out, slowly, persistently. Meanwhile, paper positioning remains cautious. Few are making bold bets. That often precedes a surprise. Surprises don't need big triggers, they need tight conditions, and silver is getting tighter. The market hasn't decided how to release this pressure yet. Up or down isn't the point right now. The point is instability. Instability grows in quiet conditions. Watch how reactions are getting faster. Moves that took days now take hours. The compression changes risk profiles. Risk managers notice that first. They start adjusting limits. Limits influence liquidity. Liquidity influences price behavior. It's a chain reaction. No single link looks dramatic, but together they matter. Silver often moves when confidence thins, not when fear peaks. Confidence right now feels shallow. It exists, but it's fragile. One unexpected data point could test it, not break it, just test it. Tests reveal structure. Weak structures fail quickly. Strong ones absorb shock. The silver market hasn't been tested yet. That's what makes people uneasy. You can hear it in the language traders use. More if and maybe. Fewer firm statements. Uncertainty seeps into pricing. That widens spreads. Wider spreads slow participation. Slower participation increases volatility. It feeds back into caution. Industrial users are adapting quietly. Some are diversifying sourcing. Others are adjusting production schedules. Those are defensive moves. Defensive moves imply perceived risk, even if nothing has happened yet. Inventory turnover is accelerating. Metal moves faster through the system. Faster movement means less cushion. Cushions are what prevent spikes. Without them, markets jump. Funding costs continue to influence decisions. High rates punish inventory holders, so inventories shrink. Shrinking inventories increase sensitivity. This loop doesn't resolve itself easily. It needs either relief or release. Neither has arrived. What's interesting is how little attention this phase gets. Most people are focused elsewhere. That's usually when imbalances grow. Silver rarely competes for headlines. It builds tension in the background. Then it reminds everyone it exists. The current price range feels stable, but stability can be misleading. Stable ranges often trap assumptions. Assumptions become crowded trades. Crowds move slowly at first, then all at once. Watch how sentiment surveys barely move. That flatness suggests indecision. Indecision is not neutrality, it's delayed action. Delayed action piles up. Eventually it releases. There's also a disconnect between narratives. Some talk about abundance, others talk about scarcity. When stories diverge, clarity is missing. Markets don't like missing clarity. They seek resolution. Resolution often comes through price, not through explanation. Silver has a history of sudden repricing, not because of news, but because positioning breaks. Right now, positioning looks careful. Careful positioning can still be wrong, especially if everyone is careful the same way. That's correlation risk. Few are hedging tail outcomes. They assume time will smooth things out. Time doesn't always cooperate. Supply-side adjustments are slow. Demand-side adjustments are faster. That imbalance favors volatility. You see hints of it in intraday moves. They're sharper than before. They just don't last yet. That's important. Short-lived moves test reaction speed. They don't test conviction. Conviction hasn't been tested. When it is, reactions will change. The question is, who's prepared? Preparation isn't visible on charts. It shows up when stress arrives. Stress also shows up in what isn't happening. New long-term projects aren't being announced. Expansion talk is cautious. Caution limits future supply growth. Future expectations shape today's behavior. If growth looks uncertain, hoarding increases. Hoarding doesn't need panic. It just needs doubt. You can feel that doubt creeping in, not openly, but subtly. Conversations change tone. Optimism gets qualified. Certainty gets postponed. These shifts matter. They precede data changes. They precede price moves. Silver reacts to psychology faster than people expect, especially when liquidity is thin. Thin liquidity exaggerates everything. Small orders leave marks. Marks accumulate. Over time, they redraw the landscape. There's also the issue of substitution. Industrial users talk about it often, but actual substitution takes time. Time they may not have, so they keep buying silver, even at higher cost. That supports demand quietly. Meanwhile, recycling response stays muted. Collection systems aren't flexible. They lag price changes. That lag keeps supply tight longer. Every delay adds tension. You don't see it in daily prices. You see it in behavior. Behavior is harder to fake. Funding desks are also more selective. They're pricing risk carefully. Careful pricing slows throughput. Slower throughput means less availability. Availability is the hidden variable here. It's not about how much silver exists. It's about how much moves. Right now, movement is cautious. Cautious movement builds pressure. Pressure seeks release. Markets eventually provide one. As this phase stretches on, patience thins. Participants start second-guessing their assumptions. Second-guessing leads to hesitation. Hesitation slows decision-making. Slower decisions tighten markets further. It's a subtle feedback loop. Nothing dramatic, just persistent. You can see it in order sizes. They're smaller, more fragmented. That fragmentation reduces depth. Depth is what stabilizes price. Without it, moves feel sharper, even if they're not larger yet. Some players are stepping back entirely. They're waiting for clarity. When people step back, liquidity suffers. Liquidity loss increases stress. It's all connected. Volatility measures remain calm. But calm metrics can lag reality. They often do. By the time they spike, it's late. That's what worries experienced traders. They've seen this setup before. Not exactly, but close enough. Silver doesn't repeat, but it rhymes. And the rhyme here is tightness. Tightness across small details. Delivery timing. Contract terms. Inventory behavior. None of it screams crisis. Together, they whisper warning. Whispers get ignored until they don't. There's also an uneven response to price dips. Some dips attract aggressive buying. Others get barely any interest. That inconsistency shows confusion. Confusion is unstable. Markets crave consensus. Right now, there isn't one. Without consensus, reactions overshoot. Overshoots create stress events. They don't need big catalysts, just a moment of imbalance. That moment hasn't arrived yet, but conditions are leaning toward it. At this stage, attention shifts to small signals. People start reading between the lines because the lines themselves say very little. Official data stays slow and backward-looking. Markets move ahead of it. That gap creates uncertainty. Uncertainty raises sensitivity. Sensitivity changes reactions. Minor updates cause outsized responses. We're seeing the early signs of that. Not consistently, but often enough. Enough to notice. Silver's market depth varies by hour now. Some sessions feel thin, others feel normal. That inconsistency is another stress marker. Stable markets feel consistent. This one doesn't. There's also more talk about optionality. People want exit paths. They want flexibility. Flexibility costs money. When people pay for it, risk perception is rising. You don't pay for safety if you feel safe. This is happening quietly. No drama attached, just adjustments. Adjustments accumulate. Eventually, they force repricing. Not because of panic, but because balance shifts. The silver market doesn't need a shock. It just needs continued pressure. Pressure changes behavior first, price follows later. That order matters. If you wait for price, you're late. Many participants know this. That's why positioning is cautious. Cautious positioning can flip fast. When it does, liquidity vanishes. That's when moves accelerate. We're not there yet, but the groundwork is visible. You can feel it if you watch closely. This phase isn't exciting, it's uncomfortable, and uncomfortable phases rarely end quietly. As the range holds, tension keeps layering. Nothing releases it yet. That's what makes this phase tricky. People assume stability means resolution. It doesn't. It often means delay. Delayed resolution increases eventual impact. Silver markets are sensitive to timing. When timing slips, reactions grow sharper. You can see it in how fast sentiment flips intraday. Confidence builds and fades quickly. That's not strength, that's fragility. Fragile systems look calm until they're tested. Testing hasn't happened yet, but anticipation is growing. Anticipation alone changes behavior. Buyers hesitate, then rush. Sellers wait, then pull offers. That on-off pattern tightens, spreads unpredictably. Unpredictability raises risk premiums. Risk premiums feed back into pricing. It's subtle, but it compounds. Some participants are already adjusting models, not because data demands it, but because intuition does. Intuition comes from experience. Experience remembers sudden silver moves. Those memories influence decisions, even if people don't admit it. You can also see more conditional language in reports, less certainty, more caveats. Caveats slow conviction. Slow conviction delays resolution. Meanwhile, demand doesn't wait. Industrial usage continues on schedule. A constant pull matters. It drains flexibility bit by bit. Flexibility is the release valve. Right now, that valve is tightening. No alarm sounds when that happens. Just resistance. Resistance builds pressure. Pressure looks invisible until it isn't. That's why this phase matters. It sets the tone for what comes next. This is the point where markets feel balanced but aren't. Everything appears manageable, yet nothing feels comfortable. That contrast is important. Comfort usually shows in behavior, and behavior right now is cautious. Caution isn't bearish or bullish. It's unstable. Unstable conditions don't last. They resolve through movement. Silver's movement history supports that. It stays quiet longer than expected. Then it adjusts quickly. When it adjusts, reactions lag. Lags create gaps. Gaps create volatility. Volatility redefines the range. That's how these phases end. Not with explanation, with repricing. We haven't seen repricing yet, but the ingredients are there. Tight availability, careful positioning, thin buffers, rising sensitivity. None of these alone matter much. Together, they do. The market is absorbing stress. Absorption has limits. Those limits aren't published anywhere. They're discovered in real time. That's what makes this uncomfortable. No clear signal, no clear trigger, just accumulation. People sense it. They just don't act on it yet. When they do, it won't be gradual. It never is in silver. The quiet phase ends suddenly. Always has. The only uncertainty is timing. And timing is what markets misjudge most.